This video is going to explain why you should be trading with supply and demand zones and how they could be used as a tool to add to your trading arsenal, no matter what strategy that you do use. I want you to think of supply and demand zones as a core, basically like a tree trunk, to many different styles and many different strategies, which will increase our odds of taking high quality setups. They're very, very powerful areas that we plot on the chart. As you can see, I have a few on my chart over here on both Tesla and the S&P 500 that not only do we take trades off of them, but it's also going to help us prevent from taking trades on the wrong side of the market and setups that we know we shouldn't be taking. I'm going to show you some real examples on the chart, and I'm going to break down a few main points on the beauty to supply and demand trading. And a few weeks ago on my Instagram, I'll post a link if you want to follow it. I definitely recommend following me at Ameritrade. This is my only account. But a few weeks ago, I posted a picture about leading indicators, and supply and demand zones are the most leading indicators you're going to get. They have to do with organic naked price action, and it works extremely well in my trading strategy. And the first point that I want to explain here is supply and demand gets us in before price moves. Now, there's nothing wrong with traditional technical analysis. What I mean by this is support, resistance, candle patterns, chart patterns, stuff of that nature. I still personally use those things. However, like I said earlier, supply and demand could be used as a core for other tools to add to your arsenal to combine and make it one big strategy that's very powerful with multiple layers of confluence. Traditional technical analysis, not always, but majority of the time, gets us in late or after a big move has already happened. For example, going to this Tesla chart, let's just say we wanted to get long using traditional technical analysis above a resistance point, and maybe we're targeting, in this example, 664, this line I just made up here. So if we were to get long up here on Tesla, some nice buying pressure that came in, this setup did work, right? So we're long above this yellow line, this yellow resistance level. We're long up here. Maybe our stop now, where our analysis is wrong, is about 638. So we're risking about 15 points to make about 10 points. Not a very good risk to reward using traditional technical analysis. Yes, this setup would have worked. However, much better of a trade would have been looking to get long at this demand zone at 630 on Tesla, whereas maybe we find an entry now at 637. Our stop loss below 630, we're risking about 7 points now to make about 35 points. Very, very good risk to reward. And we know the power behind supply and demand price imbalances, that the market has a high probability of bouncing here. So not only does it get us in before price moves, but it also gives us a better risk to reward ratio. If we got long when Tesla was above this line, our risk was too much compared to what we were going to get rewarded if our analysis was correct. However, if we got long at the demand zone, we have a much better risk to reward ratio where our risk is much smaller and our reward is much higher. This not only gives us a high probability trading setup, but this could also enable us to lose a lot more of the times because we know our risk is small and our reward is high, and our risk to reward ratio is much larger. Whereas if it was slimmer, maybe we're risking one to make one, then we can't afford to lose as much. To illustrate this point a little bit better, I've pulled up the S&P 500 right here. This is my favorite instrument to trade. And here we have a demand zone that formed intraday. We had a move to the downside, and then we had a move up. And then we got a pull back into this new demand zone that formed from this area over here. Now, traditional technical analysis, what we're seeing here is, let's just say, a inverse head and shoulders pattern. We're seeing a break of this downtrend line, and we're seeing some buying pressure coming in as soon as we break this downtrend line at 4118 or 4138, let's just call it, in this area right here where I just marked that line. Now, if I got long up here, my stop, where my analysis would be incorrect, would have to be about 25 points lower at this low. Whereas we have supply about 20 points higher at 4161. So our risk to reward is about 1-to-1. It is not a good setup. And if my risk to reward is that slim, I most of the time will not take a trading setup. To illustrate this point a little bit better, I'm going to actually synchronize the crosshairs. And on the right side, I pulled up the SPY 416 calls at the same time the S&P bounced off of this demand zone. If we were to get SPY calls at the break of this downtrend line, let's just call it at 1150, we're going to get long around $1.90 on the SPY calls when the market was just in this area right here. And if we were targeting supply, let's just say at 1255, about a hour long trade, we're going to get about 70 cents to make about 70 cents. And our risk was, again, same thing, about 70 cents. So not very good risk to reward. However, what's stopping us from getting long at this demand zone down here around 1130, maybe 1135 when the stock starts moving up? Now we're getting long at $1.50 on the SPY contracts. Our risk is about 30 cents away, but now we're going to be making about $1.20 on the position. So now we got a, 4-to-1 risk to reward ratio, 3-to-1 risk to reward. So it's much better because it offers a high probability of where the market is either going to bounce at demand or reject at supply to the downside, where our risk is very small compared to our reward, and it's going to get us in before or during before the bigger move, where price is going to bounce or reject. So it's just very clean, and it's a different way of trading, and it's a different way of thinking how the market moves. Now, I also use these supply and demand imbalances as market context to understand where buyers and sellers are factored in at. And also when we have these imbalances form, we know we have new buyers factored into the market, or we know we have new sellers which may have emerged. Market context is very important because you want to be trading on the same side as the buyers, and you want to be trading on the same side as sellers, the ones that have such a large pocket that they can move the market. Now, this goes hand in hand with number 4, because not only is it going to help us gain context and give us pieces to the puzzle to add together to come up with the story or the picture, but supply and demand zones also help me it prevents me from entering the market when I know I shouldn't be entering. If 90% of retail traders fail, do what they don't do. A lot of traders are longing when they shouldn't be bullish, and a lot of traders are shorting when they shouldn't be bearish. So knowing where these supply and demand zones are, not only is it going to help us take good setups, but it's also going to be a defensive measure or a tool and a preventative measure to enable us to not long something when we know we shouldn't be longing it, or stop shorting something when we know we shouldn't be bearish on it. The same example on the S&P 500 illustrates this very well. So going back to that day where we bounced off demand intraday and we started moving up, yes, we could make money using traditional technical analysis. Yes, it could give us more clues. Nothing wrong with it, right? But let's just say we had the mindset of a normal retail trader. For some reason, a lot of traders like being bullish on a high at daybreak, or they like being bearish on a low at daybreak. I'm not too sure why. I think it's because it's very easy to understand. But let's just say we got long on a high at daybreak, not realizing we were inside of a supply zone. So let's just remove this right now, and let's just act like we were not inside of a supply zone, right? We're now long the S&P 500 above 4,160. We're anticipating a break above this resistance level and maybe go target the previous day's highs, right? Not a bad setup if we look at this chart without the supply zone there. But as soon as we put the supply zone up and know we have sellers which emerged from the overnight session from this move to the downside, we know we have no business of being a bull right now, especially with not only it being the first time of it tested, but also buyers not really accepting value at the higher prices. Because what happens is if we got long up here, if we knew supply and demand, we would know we should be cautious to the long side. We came into the supply zone and we had an immediate dump for about 40 points from this imbalance. So this is the preventive measure by making us not think like a retail trader and not be longing something when we should be, bearish in this case. Then the next day, what happens, right? The same zone that we have from the previous day came into action again. The market opened up. We had some nice, quick little 12-point rally in the morning. If you did not expect or realize we were inside of a supply zone, this totally looks like we're going to break the previous day's high, right? This it really does. We're about 2 points away from it, and a lot of traders are going to expect the market to break this. They're going to get long, not knowing they're in a major, major trap with the market. We're providing liquidity for those sellers who are short inside of supply for their position to get filled. They view this as unfair value. The market hits supply. We move up until the last buyer buys. And what do? We dump, and we would have an awesome setup from this supply imbalance if not only we knew it was there, but it also, if we had the thought of getting long, it would have stopped us from entering this trade. A lot of traders' losses emerge from thinking something is going to happen versus just doing what the market's telling us. I made a video on this in the past recently, but this is a setup on the S&P 500, and I just want to go over the pre-market plan. I post these every single day in my Discord, the levels I'm watching, setups, and scenarios. And we had demand at 4085 that I expected the market to remain in balance above 4085 and 4071 demand, yet below 4159 supply and 4131 supply, which are these imbalances right here. Now, a lot of people see the market coming down, right? They don't realize we're inside of a demand zone. Maybe they're buying that low at daybreak and they're playing the market short. The market is designed to trap majority of the participants. So if we know there's a lot of traders getting short below a low at daybreak, with the context that you add a demand zone down there, it's a perfect recipe for the market to reverse. Same thing in this case. I see a lot of traders on Twitter and just, overall discussions just entering positions because they see the market moving down or just because they see the market moving up. These imbalances give me context. Maybe I'm looking along down here. Or if the market's coming down, I know not to get short for no other reason because we are in a demand zone and this thing had a solid bounce from the pre-market plan, hit our 4131 supply, and by end of day hit our 4159 final target to the upside. And just putting all the pieces together, it gets us in before price moves. It gives us a better risk to reward ratio depending on the trade that you're talking about. I mainly day trade and scalp using this strategy. I don't have an edge in swing trading. I never actually even swung a position. I mainly day trade and scalp. We use it as context, and it prevents us from entering the market when you shouldn't be. It's an offensive and it's a defensive tool. In this example again with Tesla, we came into that 630 demand zone. Not only did we bounce on a Tuesday, the following day we hit that zone and we bounced, and that was that example that I explained earlier. Now this consolidation over here also aligned with that resistance level, formed a new demand zone in this area over here. Let's just act like it's a green box instead of a pink one. Then the following day, not only now do we have buyers factored in at demand, we also have some new buyers who are finding value at higher prices. The market opens up the next day, hits the demand zone, and we keep going higher. Now, a lot of people are going to argue saying, oh, the market kept going up. If you're buying up here, you're chasing an extended move. That's correct to a certain extent. But if we're day trading or if we're scalping something, we care about very quick price fluctuations. When you add on context and new pieces of information as the market develops, this could have been looked at as a new setup and we could have looked to get long the next day. Whereas some people, they might be looking at it like a longer term pivot. Let's just say they want to get long maybe above, let's just say 690 or get long above 700. And from this day perspective, why did we not get long at demand? Why did we have to get long when it broke above 690 or above 700 where we already saw a 50-point move to the upside? So there's many ways to look at it. You have to fit it to how you trade, your style and your strategy. It shouldn't be I don't want you guys thinking it's a magic formula. There are many days where we don't respect supply and demand zones. There are many days where we run through them. There are many days where, they don't act like magnets at all. It's not magic. They shouldn't be used solely by itself. They should be used as a tool to add to your arsenal with other confirmation factors, with other pieces of price and volume analysis, any other indicators that you may use, although I am against them myself. A good example of this is, remember that the day on the S&P 500 where we gapped up the next day and we hit that supply zone? Well, the demand zones that formed overnight got destroyed. The same demand zone from the day prior got destroyed. We broke below it without finding buyers. I'm sure there was another demand zone like somewhere in this area that got destroyed as well. It's not magic. So don't think every zone you see is going to bounce. You must use other tools to confirm each trade, but they're very, very high probability setups that if you can master this and get control of your emotions, you have a very, very serious edge. So if you have any questions, comment them, drop a like on this video. Let's try to get it to 900 likes. I undercut it on the last video. Let's try to get 900 likes. Definitely check out the links in the description below. I offer a very in-depth A to Z course that goes over everything that I look for, how to draw these zones, how I confirm the trades, and I continuously add value to not only the course, but you also will be added to the Discord community, which is free of charge with the course membership. But on that note, I'm ending it. Peace out.